Alright, welcome to Easy Tutorial Concepts. In today's tutorial, we'll be looking at working capital management. If today is your first time of coming across our channel, please do well to subscribe to our channel and also turn on the notification bell that whenever we release new video, you'll be updated. Do well to like, share, and also comment.
Working capital management refers to the efficient management of a company's current assets and liability to ensure sufficient liquidity to meet its short-term financial obligations. As you can see, the working capital represents the difference between the current assets and the current liability. So when you want to work for the working capital of a firm, it is the difference between the current assets and the current liability. What are the goals of working capital management? The goal is to maintain adequate cash flow to pay bills and expenses, minimize the risk of insolvency, maximize returns on investment, and to optimize the use of resources. Going forward, whenever you want to solve questions on working capital, you will be needed to identify the current assets and the current liability. So these are some of the key components to solving working capital management question. So we have under current assets, we have cash, account receivable, trade debtors, bill receivable, inventories, prepaid expenses. While under current liabilities, we have accounts payable, short-term loans, accrued expenses, bills payable, we have tax payable, dividend payable, etc. Okay, so the effective working capital management, an effective working capital management involves cash flow management, managing inflow and outflow to maintain liquidity, inventory management, account receivable management, account payable management, short-term financing. What are the benefits of effective working capital management? So it improves liquidity. When you manage your capital very well to be able to meet up short-term financial obligations, it will improve liquidity, it will reduce financial risk, it will increase profitability, enhance credibility with suppliers and creditors, better decision making with accurate cash flow forecasting. Then if there is inefficient working capital, what will that lead to? If there is inefficient working capital, it will lead to cash flow problems, it will lead to insolvency, it will reduce your profitability, it will damage your credit rating, and you will have difficulty in meeting financial obligations. So by effectively managing working capital, businesses can improve their financial health, increase efficiency, and achieve their goals. So let's look at the format of solving working capital, because many times you'll be required to estimate the working capital cycle. Okay, so this is a format for estimating of working capital requirements. Under current assets, you bring, if there's any cash balance in the question, you bring your cash balance down. Then you look at the questions for stock inventories. We have raw materials, work in progress, finished goods. They are all types of stock. Then for receivables, we have debtors, which is your trade receivables. Then we have bills receivables. By the time you add up all your current assets, it will amount to what we call the gross working capital. Gross working capital. Then when you now deduct your current liability, you will have net working capital. So current liability include creditors for purchase, creditors for wages, creditors for overhead. So deduct the total of the liability from the total of the assets. You get the net working capital. This is the format we should use to solve the working capital requirements.
Okay, so we'll take a practical question. Now, for this particular question, this is for a firm that is not engaged in manufacturing, rather they are engaged in just trading activities. So looking at the information there, we are told that to prepare the estimation of working capital requirement from the following information of a trading concern, their projected annual sales. The projected annual sales is 100,000 units. This is the projected annual sales. Then the selling price. Selling price is giving us $8 per unit. $8 per unit. Then we are told that the percentage of net profit on sales. Percentage of net profit on sales. On sales. This is 20%. 20%. And the average credit period allowed by supplier. Average credit period allowed by supplier is given as 4 weeks. Then average credit period allowed to customers. Average credit period, this is allowed by suppliers, allowed to customers is 8 weeks. Then average stock holding in terms of sales requirements is 12 weeks. And lastly, we're also giving contingency allowance. Contingencies allowance of 10%. All right. So without wasting time, let's show a little workings before we proceed to the operating cycle, where you bring your current assets down less the current liability. Like we've explained that your gross working capital is the sum total of all your current assets. But by the time you now less your current liability from your current assets, the difference is called the net working capital. So take note of that. When you deduct current liability from current assets, you get the net working capital. So before we bring in our current asset and the current liability into the estimation schedule, it is important we do workings to see the total amount of sales, to get the cost of sales, and also to show the gross profit as indicated in the question. So the value of sales here will be, since the total units projected is 100,000 units times the selling price, $8, that will give us $800,000. Then we are told that the percentage of net profit on sales, so the percentage of profit on sales is 20% of the sales value. So 20% of $800 will give us $160,000. So therefore, the cost of sales, or what we can regard, since it's a trading concern, what we cannot regard as the cost of sales or purchases will be what? When you deduct this profit from the sales, it means their purchases or cost of sales is $640. So with this, we can use this figure to solve for the debtors, the stock, and also the creditor. Right. So having in mind that our cost of sales or purchase is 640,000, now let's estimate the working capital requirement. So please take note of this figure. 640,000. All right, so estimation of the working capital requirements. All right. So we have our particulars and we have the amount. Okay, so let's bring our current assets first. Under current assets, we have debtors, we have stock, which is finished goods. So finished goods in this case, since our amount is $640,000 times how many days, or what's the average stock holding period? The average stock holding period is how many weeks? 12 weeks. And we have 52 weeks. So for this question, it is assumed we have 52 weeks to make up 1 year. So it means that for finished goods, it will be 12 over 52. So 640,000 times 12 divide 52. That will give us 692. 692. Then, after finished goods, the next thing is debtors, which is another form of current assets. 640,000 times debtors are allowed, which is customers, they are allowed period of 8 weeks for repayment of their debt. 52 weeks makes up a year. So 640,000 times 8 divide 52. So that's 98,462. All right. So you add the two assets together. This will give us what we call the gross working capital. 147,692 plus 98,462. This is 246,154. We call this our gross working capital. Then you less your current liability. So current liability, we have creditors there. Creditors. So remember, 640,000 times how many weeks is given for creditors as repayment period? Average credit period by the suppliers, which is known as the creditor, they gave the company 4 weeks. That will be 4 over 52. That will give us 4 divided 52 times 640,000. And that's 49,231. By the time you less this current liability from the total of the current assets, you get the net working capital. So that will be 246,154 minus 49,231. And that is 196,923. Then if you look at the question, we are told to allow contingency of 10%. So you add that contingency of 10%, contingencies, 10% of 196,923 will give us 196,992. Add together. So the total 216,615. This is the estimation of the working capital requirements.